They laughed when this small laser company said it could reinvent itself as a defense technology powerhouse. But now, just months later, the same company that once built industrial lasers is being talked about as a potential player in the US and NATO defense ecosystem. And that's what's driving all this chaos in the stock. Big swings, big speculation, and investors trying to figure out if this is a once-in-a-decade turnaround or just another hype cycle waiting to fade. Because here's the truth. Stocks don't move like this unless something major is changing. In the past few weeks, we've seen days where the price jumped almost 20% from low to high. That kind of volatility means traders are watching every headline, every rumor, and every press release, trying to figure out what this company is really turning into. Just months ago, it was a niche player focused on blue laser technology. It made sense for industrial markets, but the business model was narrow and the profits were hard to come by. Then management made a bold move. They started reshaping the entire company through acquisitions. And not just any acquisitions, ones that could completely redefine their identity. One of the biggest turning points was when they announced a binding agreement to acquire Orbit, an SRL software firm that specializes in operational resilience. Basically, tech that helps organizations stay secure and functional under pressure. The moment that deal hit the news, the stock exploded in pre-market trading. That one headline told the market that BURU wasn't just selling hardware anymore. They were moving into high-margin, software-driven defense technology. And that's where the story starts getting really interesting. By adding software as a service to their mix, they're aiming for recurring revenue instead of one-time hardware sales. In other words, they're trying to build a business model that brings in steady, predictable income instead of betting everything on product orders. That's a massive shift. And it's exactly what attracts long-term investors when done right. Orbit itself has projected strong growth ahead. And if even half of that turns out to be true, it could completely change how investors see BURU's long-term potential. But at the same time, this kind of transformation doesn't come without serious risks. Earlier this year, the company had compliance issues with its NYSE American listing. They've also raised capital through public offerings, including a $12 million raise just recently. That means they're depending on outside money to fund these acquisitions and keep the strategy going. And that always brings the risk of shareholder dilution. That's one of the biggest challenges for small-cap turnaround plays like this. You have bold vision on one side, and on the other side, constant financial pressure to fund it. But the leadership here, and especially Executive Chairman and co-CEO Alessandro Zamboni, is clearly betting that the payoff will be worth it. Some of the deals they've made even involve government oversight, which suggests these aren't random acquisitions. It's a coordinated move into the defense and security space, and that's not a small market. The operational resilience and defense software sector across the US, EU, and NATO is worth several $billions and growing rapidly. If BURU can grab even a tiny piece of that market, it could transform the company's entire revenue profile. But let's be real, this won't happen overnight. Integration of different businesses, hardware, software, and international defense contracts is extremely complex. It takes time, patience, and the right partnerships. Institutional ownership of BURU is still small. But here's the twist. Some funds have started quietly increasing their stakes. That's usually the first sign that more serious investors are starting to take a look, even while the bigger players wait on the sidelines. It's that early stage of interest where the story hasn't gone mainstream yet, but the groundwork is being laid. Right now, the investor base is divided. Some see BURU as an exciting defense tech turnaround story, a small company reinventing itself at the perfect time when global defense spending is rising. Others see it as a high-risk play that still has a lot to prove. And honestly, both sides have a point. The company is making big promises, but it still has to deliver real revenue growth and show that it can integrate what it's buying. The next few months are going to be absolutely critical. BURU plans to close the Orbit deal, move forward with other targets like TechNet, and push deeper into the defense ecosystem. Every step of that process will be a test, and every headline could send the stock flying up or crashing down. The volatility isn't going away anytime soon. If Orbit's growth numbers turn out as strong as projected, it could force investors to completely revalue BURU. But if delays, integration problems, or funding issues pop up, sentiment could swing hard the other way. That's why this stock has become one of those event-driven plays, like where every update matters. At its core, this is a story about reinvention. The old BURU, the pure laser business, had incredible technology but couldn't escape financial losses. The new BURU is betting everything on becoming a defense and security software hybrid. It's bold, it's risky, and it's exactly the kind of move that can either make or break a company. For now, expect the volatility to continue. Every announcement will move the price, and traders will try to ride those waves. But the bigger question is whether management can turn short-term hype into long-term stability. If they can, this could become one of the more surprising transformations in small-cap defense tech. If they can't, well, it'll just be remembered as another company that reached too far, too fast. But either way, the story isn't over, it's just getting started. Disclaimer: this video is for educational and informational purposes only. It's not financial advice. Always do your own research before making any investment decisions.